and that is get comfortable with the stock market. I think gets difficult for a lot of people who are nearing retirement and are newly retired. There's a misconception that the closer that you are to retirement and when you're retired, you should have less of your money in the stock market because it's too aggressive and because it's too dangerous. But something that's even more dangerous is putting your investments in something that's not going to be able to keep up with inflation and the amount of money that you need to withdraw. And for most retirees, they're going to end up needing to take 4 to 5% annually out of their investments to supplement their retirement income. And so if you are invested in something that's not giving you at least a 4 to 5% interest rate or performance, plus then you have inflation on top of that eating away your account balance, you are going to be in trouble in retirement.
You're going in the hole. And you know, the stock market is a relatively safe place to have money if it's long term, particularly if it's 5 years or longer. I never want to put people's money in if they say they only want to invest money for a year or something like that. But you're pretty safe for 5 years. And when we were talking about before, most people live, ballpark 20 years in retirement. That's long-term money.
There's actually never, this is a fun historical fact for you, there's never been a 20-year period in the history of the stock market that hasn't gotten a positive return. There's never been a loss in a 20-year period of the stock market.
When I started in this business a long time ago, Jesse, 27, 28 years ago, my office was on the north end of town, and I went through this neighborhood called, we're going to show you a sign, a neighborhood called Autumn Wood. And, oh, that's not it. There it is. And Autumn Wood's on the north end of Lincoln off of North 27th Street. And it's one of these communities that you have to be 55 or older to live in. As I went through and met everybody in that neighborhood, there were of the older people that were in their 80s that had retired 20 years prior. So this was in the 90s when I did this. And so they'd retired in the late 70s, early 80s. And of these older people that had been retired for 15, 20 years, they kind of fell into two camps. Both of them had worries. One camp, their worry was, how much is the next Social Security increase going to be? And when you get to talking to them, what happened when they retired in the late 70s or so and sold the farm or rolled over their 401k, they put the money in the bank in CDs, because CDs were paying real high rates then. But then they started going down, and these people stayed in the CDs, and the CDs weren't enough to provide for their income and stay ahead of inflation. And now in their mid 80s or whatever, they're worried about the next Social Security increase. They're worried about how to make ends meet. The other category of people in their 80s, when they retired and sold the farm or rolled over their 401k, they put a significant amount of their money in the stock market. And the stock market had outperformed inflation so well that their worry was, how do I transfer this money to my kids or my beneficiaries without the government getting a good chunk of it? And so I'd try to help them figure that out. But I'd much rather have that worry of having too much money and avoiding estate taxes than where am I going to, how much is the next Social Security increase going to be?
And to illustrate kind of what we're talking about, let's see if I can get this to, here we go. Going back to this chart I have, it's a little bit busy, so just pay attention to what I have highlighted here. And these are the returns, annual returns of different indexes of investments, different asset classes since 1970 until the end of 2022. And so if we look at the S&P 500 index, the 500 largest companies on the US stock exchange, their average annual return over that time period, even though there was up times and low times, was 10.43%. Now, if we go over and we look at the real return, that's the inflation adjusted return. So that's the return that matters the most. It's about 6.5%. Okay. And so if you were taking 4 or 5% out of your investments and were invested in something that was getting you an average of 6.5%, your retirement nest egg is still going to be growing even as you're taking money out of it and even as inflation goes up. Okay. Now, if we look at this US bond index, which is made up of
Bonds.
corporate US large company bonds, the average total return is about 6.8%, but the after inflation return is 2.87%. It's less than 3%. So if you're taking 4 or 5% out of an account that's mostly made up of bonds or even treasury bills down here, your account balance is going to be going down as you're taking money out of it. And that's not a sustainable way to produce a retirement income.
In retirement, you don't want to be a race. You don't want to be in a race of between your retirement account and when you're going to die. You know, you can't time that. I mean, unless you know exactly that at age 85, you're going to die. You can't set it up. Sure as heck, you set it up and with your plan that you're going to die at age 85, you're going to live to 90 and be running out of money too soon. So we don't want anybody to run out of money. We want people to be happy and healthy and financially healthy in their retirement.
And for people who are maybe feel like the stock market is too much risk, there's some different options for people. So you can stay in the market and lower the amount of risk that you're taking and lower the amount of turbulence that you see in your accounts by doing several things that we help people do.
Right.
You can have an allocation of some gold in the account. You can have an allocation that has maybe some short-term, like right now, short-term treasury bills are a better deal than long-term bonds because interest rates are going up and that hurts bond returns.
Different things that we do, tools we use,
Yeah.
like with your allocation, or we can put stop loss orders on accounts that if the account goes down a certain amount, it sells you out so that you don't have to write it down.
You can also invest in index funds, which are funds that contain lots of companies so that you're not exposed if something bad happens with one company, things like that. So there's a lot of ways that you can mitigate risk while staying in the stock market. And then there's also some products that have insurance benefits on them where you can stay in the stock market and also have an insurance benefit tied in that will give you guarantees on things like income, a death benefit for your family, things like that, that are actually the ultimate worries of what we worry about. Oh, if my account goes down, then I'm not going to have any money in retirement, or I'm not going to be able to leave this balance to my kids. It kind of takes away those worries.
Right.